Welcome back, everyone, to a brand new episode of the Crypto and Muay Thai podcast. I'm your host, Chris Brookins. I'm super excited to welcome my guest today, Jesse Proudman. He is the founder and CEO of Strix Leviathan. It is a quantitative digital asset hedge fund that is based out of Seattle. I am super happy to have Jesse on today. Thank you so much for joining us. Jesse, how are you doing?
My pleasure. Doing really well. Thanks for having me.
Yeah, of course. It's always fun to talk to a fellow quant, quote unquote, within this particular space. So this is actually one of the conversations that I've been looking forward to. So I'm super excited to jump in. For the individuals that might not know you or who you are, just give a quick 2-minute synopsis of your background and also how you found yourself in this wild world of digital assets.
Yeah, absolutely. So I'm a longtime entrepreneur. I started my last company in 2003. It was a cloud computing company called Blue Box. Bootstrapped that company for 9 years and then ultimately raised about $22 million in venture money to build a private cloud product that we sold to IBM in June of 2015. So I spent about 2.5 years at IBM as a distinguished engineer, first year and a half working on integrating the product inside of IBM Cloud. And then the last year I was working with IBM Ventures to launch a blockchain-focused accelerator. So effectively over 2017, my job was to research the blockchain and cryptocurrency space and become a subject matter expert. It's a space that I've sort of tracked for a while, but never really had the intellectual bandwidth to dive into until 2017. I actually went to college with Nick Carey from blockchain.com and Eric Voorhees from Shapeshift. We were all in the same sort of business cohort at University of Puget Sound. So I watched over the shoulders of those two guys as they built those businesses with fascination. But 2017 was really the first year that I'd found the time to really dig in and understand what was happening in this space. And so the moment that happened, I was hooked.
Got you. That makes total sense. So tell us about the genesis of your fund. So obviously your background is very similar to a lot of our background where, we got introduced, whether it through someone that was actually building a company within it or was already trading it, or, just stumbled upon this new intellectual idea via a book and just kind of went down this rabbit hole. Tell us a little bit about that, but then also what made you want to sort of hop into the quant bucket. So for those who don't know, whenever you're looking for not traditional, but what I would call institutional investment, typically there's buckets of investment styles that people will look at, whether it's venture capital, there's your buy and hold, there's your index, and then obviously there's your quantitative shop. So tell us, whenever you made that leap where you're like, all right, I want to get involved in this space, what did you see in your initial foray into it that made you think that a quantitative approach might be the best way to get exposure, build a business within this market?
Yeah, absolutely. So I was watching the markets sort of over 2017 and sort of passively investing myself through that time period. And as part of the research I was doing, I was spending a lot of time at pricing charts, trying to understand what was happening in this space, and started to come to a couple of conclusions. The first was that there was liquidity here. This is a big market and there's a lot of money that moves from hand to hand. And that was interesting. And with that liquidity, there's also a lot of volatility. So prices are all over the place. I also noticed that that liquidity is fractured across all these global exchanges. So with traditional equities, you may have one stock on one exchange and you have sort of a single point of reference. Here, you have all of these exchanges trading the same assets all over the world and doing that 24/7. And that felt pretty inefficient to me. And then the third realization was that most of these assets in this asset class really, in my eyes, lack fundamental value, or that fundamental value is really opaque, that market participants can't really tell you what the value of Bitcoin should be, or Ethereum should be, or Ethereum Classic, or whatever the coin of the day is. Everybody sort of has their own perception on what that value is. And so without these shared fundamental valuation models, you get effectively pricing action that is speculative in nature. And that speculation drives sort of momentum and trend within the pricing data in a way that felt like could be identified and harnessed in an algorithmic approach. So spent 2017 kind of looking at all of that, and came to the end of the year, and my time at IBM was coming to a close, and came to the conclusion that there was an opportunity to go build a set of software that would pull down all of this exchange data, normalize it, store it, and look for those pricing trends. And so prototyped sort of nights and weekends, the first set of software to do that at the end of 2017. And it was actually 3 days after Bitcoin's all-time high in December that I sent the first text message to my co-founder saying, hey, I've got this idea. I think we should go give this a shot. So we launched Strix Leviathan in January of 18 with that thesis that in a speculative business, in a speculative market, quantitative trading can provide sort of the most reliable and consistent return profile in the space. And away we went.
Got you. Very, very, very interesting. So, as I know, probably better than most, given I'm in the quant space, you have this general idea of how you're going to attack this market, and in your mind, it is the best thing since sliced bread. But nothing, like the old adage goes, like your plan doesn't survive; it only survives first contact with the enemy. So it's like whenever you've got it, quote unquote, in the laboratory, and then you take it out in the real world, you quickly realize that there's some things that maybe you didn't take into consideration, you didn't know existed. So tell us a little bit about that. So you're like talking to your founders and you're like, all right, we're going to go run this down. We've got this general hypothesis, which I totally agree with. Tell us about some of those initial sort of forks in the road that you had to come to after you got out in the live environment and started trading.
Yeah, absolutely. And I mean, that's exactly right. There's sort of no one model that will rule them all in this space. And models that work for periods of time that start to fail in different market conditions. So that there's a constant learning that goes on here. I mean, when we started, the original thesis or the original idea was that we would trade sort of Bitcoin to altcoins on exchanges, and we would try to pick up sort of the 5 to 15% swings that happen on a pretty regular basis. And we had a set of algorithms that actually did a fairly good job identifying when those occur. But the moment you try to go put any money through those coins on a lot of these exchanges, liquidity dries up. And so we very quickly realized, like on paper, there may be a 15% swing, but once you actually go move 25 or 50,000, like not a material sum of money through these individual coins, your execution costs could be 5 to 10%. And now your profitable trade is no longer profitable. So sort of that notion that these were liquid markets, at least when we got started, that kind of vanished for us. So we kind of went back to the drawing board and looked at what the liquidity profiles of all these coins were and came to the conclusion that there actually was liquidity in sort of the top 5 coins. So back then, sort of, and now it's sort of Bitcoin Cash, Litecoin, Ethereum, and XRP. Like you can move material sums of money in and out of those coins with pretty predictable execution cost. We also realized that sort of trying to do this on exchange was going to be a challenge for us because there are so many exchanges and liquidity is fractured across all of them that to really do that well, you have to keep capital on all those exchanges and you have to build execution that talks to all those exchanges. And that didn't feel like a good use of our time. It felt like a better use of our time would be actually identifying the models and kind of building all the infrastructure to do that. So we pretty quickly moved from trading on exchange to trading everything OTC. So we have counterparties that we work with, and it's their business to go kind of build all the exchange infrastructure and just put their capital sort of at risk or have it exposed on exchange. And then they make a spread off of every trade that we execute with them. But we found that sort of the cost benefit for this with that model has been quite beneficial. And so those were 2 of our first big learnings. That OTC side is pretty interesting because when we started in 2018, the fund launched sort of middle of April of 2018. So those OTC trades were done in Skype. So you'd get in a Skype chat room and you'd have 3 or 4 different OTC desks that you'd work with. And you say, I want to buy $500,000 of Bitcoin. And you'd paste that into these 4 rooms and they'd all kind of respond with different prices and different timelines. And they're all kind of canceling or moving their prices around. It's a really inefficient way to trade and get best execution. But that was sort of the state of the art then. And that blew my mind. Fortunately, sort of a lot has changed over the last 2 years. And now all of these OTC desks or many of the OTC desks provide electronic APIs for execution. So we've ended up building sort of this execution system that talks to a bunch of different OTC desks versus a bunch of different exchanges. And that's become a really efficient way for us to trade in the space.
Got you. That makes a lot of sense. Yeah, there's a lot of initial nuances that you really don't know about until you truly get in this market and get your hands dirty. And that experience is a little bit similar to our particular experience, the fund that I manage, but different in a little bit of ways too. Did you guys also find out that there was issues in terms of data collection quality to build said model? So you took not a hard pivot, but a pivot from your existing strategy, looking at essentially the alts, and then flipping it back into Bitcoin to saying, okay, we're going to focus on the top 5 because it's got the most liquidity attached to it. Was there additional data, you know, restrictions or constraints or quality issues whenever you look to build out a new suite of algorithms or new model to be able to trade those top 5? Or was it a lot better than the existing data that you were looking at with some of the alts?
Yeah, I mean, it's hard to say. There's just not enough data in this space because the space hasn't been around long enough. Like that's the biggest issue. The data itself is okay. You get a lot of oddities. Like you go back and you can see flash crashes. Like there was one on Kraken where Ethereum went down to 10 cents, and like that'll show up in the data. And so you got to think about what do you do with that in your historical models. Like that happened, so it was a real event. Like Ethereum actually traded for that price, but on one exchange in the context of this global asset. So there's pieces like that we need to think through. One of the biggest things we've done over the last 2.5 years is move away from time-derived pricing data. So a lot of people approach this space and they say like, oh, I trade 240-minute candles, or I trade one-day candles, or I trade 15-minute candles. And what we found is that this space, like I'm a big boater, and in boating, my saying is like it's hours of boredom followed by moments of sheer terror. Like that is this space. And time doesn't necessarily dictate price action. So you can have a lot of market movement in very short periods of time, and that manifests itself like you're late if you're using pricing data. And so we ended up building a system that looks at the individual matches, like the trades that are occurring on each exchange, and derives candles based on capital flows happening in the market. And that effectively removes time from the equation. So instead of looking at a candle once a day or 3 times a day, the system can look at 12 candles a day, or it could look at, depending, March 12th of 2020 this year, where the markets sort of fell apart over the course of 4 or 5 hours, it can look at 170 candles. And so in moments of massive market movements, it slows down that time for us in a way that the system can be more intelligent about how it's processing trades. And that's been a big learning for us. I think most or not all of our development of new models over the last 9 months has been based on these dollar bars or cash candles, as we call them. But yeah, data is certainly a tricky one. I mean, we built from day one this data ingestion system. So we have direct connectivity to all the exchange, to 9 or 10 or 11 exchanges. And we suck in all of that data on our own. And that was a big investment for us to build that infrastructure. And we were fortunate that we had sort of the engineering capability and really the time on the front end to be able to go build that. Not everybody has that ability right now. And so you rely on sort of some of these third-party data vendors. And that can be expensive and potentially error prone because you're sort of at the whim of what they're providing. So yeah, it's just the challenge here is there's not enough data. And the data that exists, like everybody's kind of looking at the same thing. So try to figure out how to chop it up and look at it in different ways that can give you additional edge in these markets, I think is really key.
Yeah, that's really interesting. Whenever you talked in the frame of how you've removed time from the equation, was that something that you saw like over time, like you articulated a little bit, or was it, an additional technique that you saw and you're like, okay, maybe that might have applicability to this particular market, or was it, something else entirely? Because it sounds really interesting and actually quite valuable in this particular space.
Yeah, so our CIO, Nico, is just an avid reader. And so he goes out sort of in his spare time and he'll find investment theory books or white papers or theses and from the traditional asset world and read those. And what we found is that a lot of the commodities strategies and the commodities approaches really do apply cleanly here to this space. They require some modification, but they apply cleanly. So this idea was derived from some of the research that he did. we sort of got tired of sort of being late to a number of these moves in 2018, and started to think through how do we remedy that. And just using shorter timeframes didn't feel like a good remedy, because you start to get too much noise in the data. Sort of the randomness becomes too apparent, and that can have big impacts on the strategies. And so we're trying to figure out, how do we look at sort of the same duration of effective time frame? Like, how do we get cleaner data with less noise in it, but do it in a way that gives us sort of that cleaner perspective into what's happening in the market. So yeah, fortunately, he's a great thinker on the research side when it comes to these new ideas.
No, I like that a lot, and I think that's one of the perks of, having a little bit more of a smaller shop, or being at an early stage, to where, you don't have a gaggle of data scientists or programmers, working for you, where you can have this kind of like symbiosis and or enough time to experiment. Or I would say, like, the culture is still very much in an experimentation, like discovery, get to the root of truth. And I found that some of our best discoveries have been exactly through that. Ours has been a little bit more through like academic work, given the people that I've partnered with have been like PhDs from Carnegie Mellon and such. But it requires a certain like crafting and molding over to the traditional financial markets, and then taking into consideration some of these more like very domain specific things. I agree with you. I think digital assets in and of themselves trade very similar to commodities, because commodities are driven by supply and demand. And without a thorough like fundamental valuation where you can say, all right, well, this is the multiplier of these cash flows of stock X, Bitcoin or any other digital asset is like, all right, what's the supply? And then how do we measure demand? And then how do we see which is currently winning? And that's going to be which way the wind is blowing in terms of price. So I think I love to hear like that kind of experimentation mentality, to just actually learn and evolve and find truth within this particular market,
Yeah, and it's interesting in this space. I think a lot of the quant shops that operate in crypto have looked towards more market neutral strategies, where they're doing exchange arbitrage or market making, or sort of other higher frequency style of trading. So there aren't very many funds that are trying to trade quantitatively and directionally, sort of in combination. So it's been a little bit unique for us as we think about sort of other folks that we can shoot ideas or brainstorm ideas with. It's kind of a fascinating element of the space.
Yeah, for sure. I mean, we've had this conversation before, but we're very much of a cut from a similar vein, where we're directional as well. A little bit low to mid frequency, and yeah, we don't look at market neutral strategies or anything like that. It's just not within our domain expertise. We had a specific set of skills that led us to this particular area, and we'll continue to evolve it until we feel like we need to kind of branch out. But that does seem to be kind of like the soup du jour of today, is very market neutral strategies, and seemingly generating alpha without layering on any additional risk, which is just not possible. It's just unknown or unaccounted for risk that I hope, well, eventually it'll reverse in a negative way. But
we've seen that this year. I mean, there've been four fund blowups as a function of volatility this year that at least are public. Which, and I'm sure there are others that have shut down for any other number of reasons. But yeah, I mean, it's a challenge. I mean, you don't print 40% year over year risk free. It's the tail risk in this space is huge.
100%. So talking about risk, how do you guys look at risk, and how do you look to manage it? Because one of the things, that's something that is like super important in this market, given just like you said, whenever tail risk comes in, or I'll say that there is a variety of regimes that occurs within this particular space. And whenever it fluctuates and changes from one regime to the next, it typically does it in a violent manner. It's not, like an old man easing into a bath, where it's like, all right, well, now it's a bear market instead of a bull market. It's typically quite violent. So there's that element of risk, but also kind of how you talked about before, there's liquidity risk as well, where it's like an accordion. It seems like there's a lot of liquidity, but whenever shit hits the fan, it shrinks up very, very quickly. So tell me, as much as possible, how you view risk, whether through those two particular areas that I kind of mentioned, or maybe you don't even look at those and you look at, option A through B.
Yeah, I mean, there's risk all over the place in this space. I think it starts for us with counterparty risk. So that's the first thing that we look at. And whether it's the OTC desks that we're trading with, the custodians we work with, any of the borrowing or lending facilities that we work with, the exchanges that we work with, sort of all of that needs to be considered. And it's sort of like the first time you go through an exchange hack, and you get that feeling in your stomach. Like we had capital on Binance I think it was April of 19, when they had I think it was about a $30 million hack. And they ate the loss, and no users lost capital in that experience. But sort of sitting through that for us was not a great feeling. And so that continued to help steer us in the direction of how we wanted to custody our assets and where we were going to keep things. So we've done a lot of diligence with all the counterparties that we work with, and we track sort of our exposure to every individual counterparty as part of our broader trading system. So we know exactly sort of what the exposure is to each individual counterparty. So that's kind of the first step for us. The second step is really sort of market monitoring. So because this asset class trades 24/7, it doesn't sleep. And so you need a system that can actively track the markets and your positions around the clock and can make decisions for you. And that's where I think a lot of the quantitative shops in this space have an advantage over discretionary shops, because unless you've got a full-time trading team staring at the screens 24/7, like you're going to be asleep when the market's making certain moves. So our system, and we've built a proprietary platform we call Octopus. We have a whole demo on our website, but part of that system is watching the markets 24/7 and making these trading decisions based on what's happening. The third part for us, again, was kind of removing time from the equation. So you're exactly right. When these markets switch regimes, they do it in a violent fashion. And again, trying to identify those patterns and the times and those times that that's happening in a way that we can benefit from is helpful. And then the last piece for us, this is an area that we're still working on, is really regime detection, in the sense of like the models that we run today do very well when the market's trending up, or do very well when the market's trending down. They do not do well when the market is range bound and is choppy. And so being able to identify those periods algorithmically or quantitatively, that's a big emphasis for us, and an area we're spending a lot of time on this year. It's just a difficult problem to solve, but one that we're spending a lot of energy on.
Yeah, I look at that in particularly as one of the biggest areas of risks within this particular market, is because, for all the reasons that I said, whenever things switch, it's typically in a violent fashion. And you want to make sure, at least for us, we need to make sure that we have the appropriate calibration of our models to make sure that we're taking into consideration the particular market regime that we're in. Like you said, there's no one model, there's no one trading system to rule them all, and we won't pretend like we've got the genetic algorithm where it's like, it doesn't matter. We'll just let it run, bear, bull, it doesn't matter. It's like, no, the regime matters a great deal. And being able to identify that, possibly proactively, is a way to be able to mitigate risk, but also give yourself a little bit more comfortability whenever you think you should be a little bit greedy, or whenever you think you should be a little bit fearful as well. So we talked about the risks, like how you view that within this particular market. Where do you see the areas of opportunities? Meaning, obviously, we're both directional quant. So in your eyes, you see that there's some green space there. Are there other like green spaces? Obviously, don't divulge anything that you guys are working on, in confidence, but I'd be curious if you thought or just looked at it conceptually. It's like, I see a lot of people over here, but they're ignoring this entire green pasture, or something that has the ability to become a green pasture that might be suited for how you view the market, whether it's through your strategies or just in general, like how your intellectual mind works.
Yeah, I mean, I think the whole quantitative approach to this space is sort of greenfield. There aren't many directional quantitative funds in this space, and there aren't many because it's hard. It's not an easy way to trade for any number of the reasons that we've talked about over the last few minutes. And so kind of building, and we've really approached this with a software perspective. Like I'm a technology entrepreneur. When we started this company, the thesis was that we would build a software platform that would solve these problems. We wouldn't do it sort of in spreadsheets. And like many of the funds in this space are operating out of spreadsheets. So we really think from a competitive differentiator or competitive differentiation perspective, like this software platform we've built fundamentally changes the nature of trading this asset class for us. And at the end of the day, this is an asset class that has incredible volatility, incredible drawdowns. Like it's gut wrenching. Everybody says, oh, just go and buy and hold Bitcoin and you'll do great. And like that thesis it's a great thesis. Like on paper, you would have done very well. But it takes quite a bit of intestinal fortitude to hold through a 70 or 80% drawdown. And a lot of people don't. Right? You get that 40, 50, 60% drawdown and people are like, well, I'm the idiot in the room and I'm going to sell this and move on and take my losses. And so part of our objective trading this asset class quantitatively is like, can we tame the beast? Can we take an asset class that is wild and reduce the volatility and get a better risk adjusted return in aggregate than just buying and holding a bunch of these assets? So that's been a big part of it for us. And again, like we're living in an experiment, right? Nobody knows how these technologies, these blockchains are going to evolve over the next decade. Nobody has a clue. Even Bitcoin, that's been around the longest and is obviously the most sort of stable network out there. We have no idea what's going to happen as the mining rewards converge towards zero and sort of the fees are going to have to support securing the network. We have no idea. Nobody has a clue. And so to say sort of Bitcoin is the only asset you should buy and just buy and hold that forever and you'll be rich. Like to me, that's like saying Yahoo is the one technology stock that you should buy in 2000 and just hold Yahoo and you'll be rich forever because it is the best stock. Like you need to be able to approach this in a pragmatic way and realize that it's really at the end of the day, liquid angel investing, and that you need to place a bunch of bets and be smart about those bets and consider effectively how you're rebalancing those bets over time and as you get new information. And in my eyes, sort of that quantitative methodology is the best way to do that.
It'll come as no surprise probably to listeners, but I completely agree. I think angel investing is a little bit more accurate. I've said before, it's like liquid venture capital investing where, if you were sitting in the room and obviously you've been one of those entrepreneurs in the room across from the table, everyone thinks that venture capital is very, very scientific. But at the end of the day, it's just individuals across the table looking at one another saying like, all right, I think you're worth X. It's like, well, I think, we should be worth X plus 2. And then if there's an agreement, that's where the valuation is. It's the same exact process, except it's done each and every single second on a liquid exchange. So I think it's even a little bit more to your point, early stage where it's angel investing.
Well, I think that the key piece there is like, it's retail, right? There are retail traders around the world that can trade these assets 24/7. Like venture investing, it's an institutional process, and there are limited market participants, and there are a limited number of entities that can sort of set the price on things, and it's largely sort of a club of people to some extent. Like this is you got people on their phones sitting on beaches in Thailand or in Europe or in Australia, all over the world, in China, trading these assets and sort of setting their own perspective of price on this market. And that to me is fundamentally unique.
That is a very that's a very astute and additional like sort of component where you add in so it's like, I can't remember who I said it before to, but it's like a perpetual .com bubble. I see this being a perpetual .com bubble, given there's always going to be new projects, very much like there's always new startups, whether they want to attack the incumbents or whether or not they want to create a new market use case or new vertical. I see it as a perpetual .com bubble because there's always going to be that opportunity for retail participants to play in, because even as the big boys move in with their sophistication, whether it be on the quantitative side or not, they're never going to be able to participate in some of the smaller caps. And that can be even Bitcoin. From anything outside of Bitcoin right now, they can't even participate in. So there's always going to be,
even from a regulatory perspective, right?
Yeah, 100%.
like that's the funniest thing to me. Everybody cites this Paul Tudor Jones article to say, oh, like they're investing in Bitcoin, but from a regulatory perspective, they're buying Bitcoin futures. Like they're not even buying spot Bitcoin, which is great. I mean, it's wonderful to have market participation, but it's just it's so funny for people to talk about sort of the institutional money that's going to come enter this space. That's been the drumbeat since 2018, and the regulatory landscape is so challenging that I think we've got a long time before sort of that true sort of quote unquote regulatory or institutional capital actually is here.
100%. I mean, even with Rentec too, everyone's like, oh, Rentec's in the market. It's like, no, they said that they were instituting like within their mandate that they had the ability to trade futures. They didn't say that they were going long. They said that they were going to consider and explore as something to trade. It's like, I can guarantee you that Rentec doesn't give a shit about the long-term value prop or whatever crypto Twitter says. They're in it to make money. And if they smell blood in the water, they'll be, another big whale dumping on the overall market. But they're one of the few people that have the ability to participate from that particular realm. So there's a lot of very similar type narratives. With that, I put out a piece in Forbes talking about like sort of like it's dichotomous now, where everyone, the drumbeat, just like you're talking about, was saying since 2018, saying institutions are the next big thing that is going to take this market, to the next bull run of 2017. But now everyone's saying no, it's going to be retail investors because of everything that's going on. Do you buy into any of that, or do you have any particular thoughts on how you track that? Obviously you and I, we look at the data and just sort of just let that tell us what it is, but there's still like intellectual curiosity that kind of piques us every now and again. So do you look at any of that and place any weight into it?
We don't look at it from a sort of a trading perspective. I mean, we look at it from a curiosity perspective. I think people like to put narratives on things because it makes them easy to understand and easier to explain to people. And it's harder to write articles about things when you can't put a narrative on the article. So, the institutional side, it's been there forever. The retail side is fascinating to me because retail got so burned at the end of 2017 that I think it really caused a large exodus of folks out of the space through 2018 and 2019. And sort of if we think about a lot of the cause of the 2017 run up, a lot of it was driven by this ICO mania, this notion of sort of quick, easy money, get rich quick. And that hasn't existed. Like no alternative has existed in this space since the end of 2017. The ICO sort of mania is over. But now we're seeing this whole DeFi movement and yield farming and all of the sort of growth in tokens associated or coins associated with that movement. And this is the first time I've sort of seen something that feels like it could attract that retail base back into the space. It's like the way people talk about DeFi, most of it's not like, oh, this technology is really neat. It's, oh, look, here's a way to make 100% annualized return. It's just about how I get rich quickly. And that's a compelling case for a lot of retail traders. It's the same reason people go on Robinhood and read Wall Street Bets and trade options there. Like they want to make quick, easy money. And so I can see this DeFi movement sort of leading to a surge of additional retail traders. And like I see it just from the people that I know that were active in this space in 2017 that I haven't heard from, or I haven't heard about this space from them in a number of years. And now they're back sort of interested again in what's happening here. And I think that DeFi piece is moving a lot of it. So we'll see. I definitely think, so like, have people forgotten how burned they got from the end of 2017 yet? And if they have, and they want to come back and they feel like the opportunity outweighs the risk or the pain they felt, then I think we'll be in good shape. It's funny trading these markets, and you've probably experienced this as well. Like losing money, it feels 10 times worse than gaining money. So if you lose 10%, it feels so much worse, 10 times worse than being up 10% in a month. And it takes a lot longer for that sort of pain to wear off. And so it's a matter of, do those 70-80% drawdowns from 2017 have people forgotten those memories yet?
Yeah, it's tough to say. I mean, I think from a high level, it seems like they might be, because this is, we're not exactly at the exuberance stage just yet. I still think there's a little bit of like sector rotation. Like you're seeing alts begin to lag a little bit, but the large caps begin to outpace them. So there's not, you don't see like that tandem, everything is just going limit up day after day. So like the exuberance isn't there, but you're gradually seeing it more like little by little. So I think you're right with that. And it seems that, people are starting to forget a little bit. Humans in and of themselves have a short memory, and maybe 2 years is enough time, especially whenever they've got free money that is coming via stimulus checks, and they're saying like, all right, well, maybe I can just, if you're one of the fortunate ones to still have a job, you're saying, all right, well, maybe I'll play with this a little bit, take 600 from it, or just rock the whole boat and, put it in one of these hot tokens that I've heard about that's going up 100%, 200%, or anything like that.
Right. Well, it's more compelling when you see things like Cardano up, 350%, or Link up 424% over the year, or Ethereum up 200. Like those are numbers that get people interested again. So yeah, I think you're exactly right.
So you mentioned one thing prior, like narratives, which price FOMO in and of itself is a narrative to draw people in, saying like, I want to get rich quick. It's like, hey, I want to get rich. You want to get rich? Like, let's get rich together. So one of the narratives that you sort of not taken aim at, but just pointed out logical flaws within it recently has been the stock to flow model, which was made famous by an anonymous analyst on Twitter named Plan B. Talk us through that. So for those who might not know, like talk what the stock to flow model is, if you feel comfortable doing that, but then also just talk about your general criticisms around it, or the sort of the conclusions that you arose by looking at it through the way that you view this particular market.
Yeah, absolutely. So, I mean, we started off looking at this because if you operate under the thesis that institutional money is coming, you have to know that institutional money has hordes of analysts that are going to look at valuation models and they're going to form their own opinions. And so if this space takes a model like stock to flow and says this is the appropriate valuation model, and that everybody should follow, and here's why you should invest in Bitcoin because of the stock to flow model, that's the model that institutional investors are going to look at first. And so we felt like if that's the case, that model needs to stand up to scrutiny. And you see, it's like you've got fund managers of multi-$100 million funds putting it in their letters to their investors. Like, here's why we believe Bitcoin's going up, because the stock to flow model says it's going to go up. You've got people with huge Twitter followings or huge media followings, like they promote this model. And so we felt like if that's the model that everybody's going to use, like let's take a deeper look. And so the thesis of stock to flow is that an asset's valuation can be derived based on the notion of how much stock is available, like how much of the asset is available, divided by how much flow, how much new quantity of that asset is produced. So in Bitcoin, we know what the stock is. Well, first of all, we know there's only 21 million sort of units, or the thesis is there's only 21 million units. Like I think that could be changed in code at any point in the future if you get miners to agree. But assuming they don't, so 21 million units, we know that. We know what the emission schedule, the mining schedule of new coins coming onto the network looks like. And so the argument is, knowing those data points, you can create this model that effectively gives you a US dollar valuation based on the stock to flow ratio over time. And like in premise, like it sounds like a logical, great model. But when you start to kind of pull the covers back, like things fall apart. And the first big issue is that the model sort of ignores the whole notion of inflation. And like it gives you a couple data, like the white paper that Plan B wrote up gives you a number of data points, affiliated data points using gold and silver, and the sort of the stock to flow ratios of those assets, trying to use that as an example or as another asset that sort of fits this model. But when you go and you map sort of the stock to flow models of or stock to flow valuation of gold over time, and you adjust it for inflation, you start to realize like the model doesn't apply to gold. So there's issues there. There's issues with the way the The actual equations are calculated, like the co-integration of the variables. Like it's effectively a y equals mx plus b equation that we all learned in sort of middle school or high school math. The variables have to be, you have to understand the way that equation works to understand sort of the validity of the model. And so you dive into all these pieces and it just starts to fall apart very quickly. The fascinating thing to me, and like, I want the price of Bitcoin to go up just as much as anybody, but I want the models that we use to be able to stand up to scrutiny by analysts that are going to come look at them. And this one doesn't. And the fascinating thing is that it has become sort of this religious model in this space. So the moment you question it, you sort of become an enemy of the broader community. Like people have so much belief that, well, Stock Flow says Bitcoin is going to be at $50,000 by the end of 2020. Like it can't be wrong. That's why I'm putting money in. And again, this goes back to sort of my original point that these valuation models aren't shared amongst market participants. So if everybody agreed on Stock Flow as a valuation model, like that might have some power in sort of setting price. But that's not the case, like because it's not a logical model. It's been pretty fascinating. We did a full blog post audit with all sort of the nuances, and then a number of other people have done sort of similar or additional analysis is on it. And the blog post is long. I mean, that's part of the thing. Like it's much easier to just put out a model that says buy one Bitcoin and you're going to be rich tomorrow than it is to explain coherently and simply why that model is incorrect. Like it's harder to debunk a model than it is to create the model in the first place in terms of doing it in a coherent way. So it's been a fascinating experience for us. Like at the end of the day, we want the space to stand up to scrutiny. We want the space to be taken seriously. We want institutional investors to not look at the space as a joke. And that's sort of the concern we have with the promotion of the model of the Stock to Flow model as it stands.
Yeah, that's kind of like the dark side of crypto, to where, it's great for a lot of reasons, but you get these fanatics, for lack of a better word, that attach themselves to something simply because it confirms their existing bias, where they think Bitcoin is the best thing since sliced bread and it's going to go to 20, 30, 40, 50, 100,000 per Bitcoin. And you've got something, data, a quant model telling you that you're right. It's like, well, hell yeah. And anyone else that sort of goes against that defined grain, they're not going to be happy about it. So we've seen that time and time again. And Stock to Flow is one of those very pervasive ones. So I had Marcel Berger on a little while ago, and he talked, his story is very interesting, from like validating, saying like, hey, this works via co-integration, but then going back and saying, no, co-integration no longer applies, so that the model no longer applies. So you're still seeing people look at it, reference it. Plan B has tried to make some adjustments to it. Now his latest is he's making applicabilities to the correlation or co-integration to the S&P 500 as well. I don't know if you've looked at any of that of his most recent work.
Yeah, we haven't spent a lot of time there. I mean, ultimately, like, it's okay for models to become wrong, right? There is no one model that will always be right.
100%.
And the model may have been accurate or been helpful or beneficial during certain periods of time. But at the end of the day, like it's not a valid model, and there needs to be acknowledgement of that. And I think the challenge I have with the way he presents himself, like anybody that questions the model is blocked. There's not a conversation. There's not an acknowledgement that the model no longer apply. So it's fine to change the model. Like by all means, like adapt it, update it as you learn more. Like that's the entire world of quantitative finance. You're always learning and always discovering new things. But no, we haven't spent a bunch of time on the new pieces or on the new research. It was just an interesting research topic for us, one that we felt like it was important to do as a function of that institutional awareness. Like I was just tired of seeing these big funds use it as a promotional material in their letters. Like it didn't feel like a intellectually valid argument to go use to attract new capital to the space. And we felt like it was important to express that.
I mean, at the end of the day, it probably better than most, is no one really gives a shit, like whether or not it's right or not. If it resonates with your investors and they're nodding their heads, you're like, oh yeah, yeah, for sure. And you just continue to push the stock to flow piece of paper across the table. So it's one of those things where, we have, critiqued it. We've looked at co-integration. We're like, okay, but then further went back, and there's also a handful of things too. I mean, the space in and of itself, and I've been guilty of it sometimes as well in the past, is just sample size plus confirmation bias. It's like,
Yep.
well, it's historically acted like this. It's like, that was 3 times.
Right.
Like, that's not
Yeah.
a valid sample size to say historically, whenever this ratio goes to 2, that it's the best time to buy or to sell or whatever it may be. You
Right.
know, not
The two previous happenings caused bull runs. Like, okay.
Yeah, it's like everyone knows that after the halving, it meanders and then it goes up. It's like, okay, that totally could be 100% true, and I'll ride that trend. It's like, but we've got to be honest with ourselves as a community, but also as analysts, saying that's just a sample size of 2. Just because it happened prior doesn't mean that it's going to happen right now. The market structure is different. The participants,
Well, the whole mining like the mining
yeah.
ecosystem is worlds different. The derivatives ecosystem is worlds different. I mean, this entire asset class has evolved so dramatically between the last halving and this halving. I mean, like I said, I would love for the price to rise. I would love for stock to flow, price predictions to materialize. I would love for sort of the halving to kick off another 2017 style bull run. I think we all would. All market participants in this space benefit when the price goes up. But we have to be honest with ourselves and, and be honest about the data that we're using.
I completely agree. It's just it's one of those things. We could go on it hours and hours. With that being said, do you still believe that it is 100% necessary to have some type of valuation model that stands up before institutions make a demonstrable plunge in terms of allocating to this space? And do you think it needs to be quote unquote quantitative? So stock to flow, it's very rudimentary mathematics, but it still falls within the quantitative bucket. Or do you think it needs to be something more along the lines of what you would see from a corporate finance valuation, or I should say security analysis, where it's like, all right, the multiple, like the ratio of active addresses divided by blah,
Yeah, like
blah,
the
blah.
NVT models. Yeah.
Yeah. Do you think that something needs to float to the top and remotely hold its water whenever it comes under scrutiny before institutions truly make a demonstrable jump in this space?
I'm torn. I did think that for a long time. The Paul Tudor Jones article, and he had one line in there. It's like, just buy the fastest horse. Like, at the end of the day, I think there's enough capital that will believe in that approach that could sort of tip the tide. And in a lot of ways, sort of institutional investors don't want to be first, but they don't want to be last, right? So when you get the first couple of people beginning to allocate to this space, you get to a critical mass that will start to tip sort of that bucket in, and I think that will accelerate in meaningful ways. And it's fascinating that we're in this sort of period of economic discovery in the traditional world of assets. With we've printed more money in the last couple months than over the last 2 centuries. Like, it's again, this is all an experiment. Nobody knows how this is going to end, and this really should be the time for an asset like Bitcoin to shine. And so it just takes enough people sort of believing that, and enough people with very big balance sheets believing that, to make proportionally very small investments off those balance sheets to make a material difference. And it's like, we talk to family offices all the time, and it's sort of we see this pattern time and time again. Like, they just don't want to be the first. They don't want to be wrong. But once that first set of capital comes, I think that may be enough.
Yeah, I've said recently that I think an additional impetus outside of family offices or other institutions not wanting to be the first, but also not wanting to be the last, is some of these larger pension funds or retirement funds having shortfalls. So it's like, oh shit, I've got all these unfunded liabilities and 20% of the workforce is retiring next year. And I need to figure out how I can plug that hole or remotely slow down the leak. And then you just look, it's like, all right, quick, what's over the past 5 to 7 years, what's got the highest expected return? And then that easily points you straight at digital assets. Again, it's going to flow to the top, and then it's going to, be more of what you see with Paul Tudor Jones. It needs to be regulated and all that. But I think that is one of the potential impetus that could open the floodgates for like that 1%, 3%, 5% allocation of some of these really large institutions that have billions and billions of dollars under management.
Yeah. Yeah. So the next 6 to 9 months are going to be fascinating sort of how that plays out.
It's going to be really, really interesting. Before we wrap up, do you have any, I know this isn't necessarily what you do, but do you have any prognostications, or how do you feel about the market currently where it's at? So we've had these 2 months of essentially just treading water, and now we've since had a very parabolic move up in classic digital assets fashion, trying to recoup, the past 2, 3 months of inactivity within, 10 to 14 days. Where do you see the markets moving forward, if that's anything that you guys look at?
Yeah. I mean, we look at it just again from a curiosity perspective. I mean, we need to see higher highs in this space. Um, we need to see that to feel good about where this market's going. It's been 2 years of lower highs on sort of higher timeframes. Ethereum has certainly helped. Like, we're seeing Ethereum prices back to where they were sort of at the beginning of 2018. So that's the type of price action I think we need to see. Bitcoin, I think that sort of that $12,000, $13,000 price point, $14,000, like those levels need to be cleared and held. And I think that will begin to indicate like, okay, there's actually potentially some legs here for a longer sustained move up. Otherwise, we're just looking at sort of these continued sort of, call it Q2 2019 or Q1 2020, these move up to higher low or to lower highs, where it then just retraces back down. So those are pretty key levels in my eyes. The sort of flash crash that happened last weekend, and the recovery from that, I think is in my eyes indicative of the interest. Like, people are feeling like this is a viable and compelling level to buy in at. In our eyes, I would rather see a slow grind up here over the next couple of weeks, and kind of clear those levels in a sane and managed way. And so it'll be interesting to see if that happens, or if we continue to see sort of the liquidation driven and speculation driven impacts to the market like we've seen over the last couple of weeks.
Yeah, I agree. I think anything that's sustainable. So I think that there's definitely something different here. Potentially might have a little bit of legs. It's too early to tell whether or not it's just going to fall into the high time frames, lower highs, and ultimately reverse. So I look at what happened in 2019 post the Libra pump, or whatever you attribute to doing the pump, and then ultimately sort of reversing. And historically, Bitcoin's the second half of the year is not overly great in terms of returns. So I'm still looking at that as a possibility, but something does feel a little bit different. But we still need a little bit of follow through, preferably of some kind of like controlled manner, where it's not just 30% in 4 days. And it's one of those things. It gets people excited. It generates that FOMO, but ultimately, it sows the seed of eventual reversals. Where I think some of the newer participants that are looking to jump in aren't necessarily sure about that. In particular, if they're coming from more of a retail background.
Yeah, absolutely. It's going to be fascinating to watch this play out. I think I am more encouraged sort of at this point than I've been at sort of either call it Q2 2019 or Q1 2020. Just it does structurally feel different, but that doesn't matter. That doesn't matter in this world.
Yeah, no, it doesn't matter in this market at all. So I think with that's a perfect place to sort of stop it. Jesse, I appreciate you jumping on the podcast, having a conversation, shooting the breeze and telling the world about how you view things from your particular manner. I'll make sure that I include all links for Strix Leviathan whenever I kick this out. And for anyone that hasn't checked out the blog talking about stock to flow, and also Jesse's Strix Leviathan has pretty good, interesting blogs in and of themselves. So I would encourage anyone that's got that intellectual curiosity, whether through a data perspective or for more of a mathematical driven perspective, to check it out. So Jesse, I appreciate you taking time out of your day, and I will see you next time.
Thanks so much for having me.
All right, everyone. I'll see you next time. Thanks.